Welcome to the express videos relating to ACCA paper F7. Don't forget to download the express notes from our website at www.dexpgroup.com. We'll be talking about all the standards which cover the asset side in the statement of financial position, if I may say so, and we'll talk about IAS 16, property, plant and equipment, IAS 23, borrowing cost, IAS 38, intangibles, IAS 40, investment property, IAS 20, which deals with government grants, and IAS 36, which covers impairment of assets. Just make sure you remember first the definition as per the framework for an asset, which is a resource that the company should control in the first place, and then it should bring us an inflow of future economic benefits. If we don't, one of the two conditions is missing, either we don't have control or there is no inflow of future economic benefits, we don't have an asset, or the asset, in other words said, has been losing value or it has been impaired. IAS 16, property, plant and equipment, covers non-tangible assets which are used by the business for more than one accounting period, and they are used either for production of goods, rendering of services, for admin purposes, or for rentals to others. It actually excludes investment property, which is specifically covered by IAS 40. It also excludes the disposal groups, if you remember the last video, covered by IFRS 5, non-current assets held for sale and discontinued operation. Basically, in all these standards which we'll cover together, we will actually cover the following. When should we actually recognize an asset? At which value? So that's initial recognition and initial valuation. We'll talk about subsequent valuation, any enhancements that we can bring to the assets, write-off periods, and disposals. So we will do this for tangible and intangible assets, for investment property, and then we'll deal with other two IFRSs or ISs, I should say, which deals with government grants and borrowing cost. So coming back to IAS 16, property, plant and equipment, the initial recognition, basically when should we actually recognize an asset in our statement of financial position, and the immediate answer that should come into your mind is as soon as the company has control over the asset, not ownership. And this complies basically with the framework definition of an asset. IAS 16 requires component accounting. So basically, if we have a bigger asset like, let's say, an airplane, we actually will recognize the full asset unbundled into its components. Why we do this? Because the subcomponents will actually have different useful life. So, for instance, in our example with an airplane, we will actually depreciate the engine over 10 years, or the exterior of the plane over 20 years, the interiors, the seats, the lighting, the flooring over 5 years. Initial valuation. Okay, once we decide that we do have an asset and we have to present it in the statement of financial position, we will present it if and only if we can put a value to it. The initial valuation for an intangible asset will actually cover all directly attributable cost. Okay, the standard says in actually bringing the asset to its intended location for its intended use, and that will include site preparation, irrecoverable import taxes, delivery charges, professional fees, attributable borrowing costs, which we'll cover when we discuss about IAS 23. It will exclude, for instance, abnormal costs in installation, any training costs for the staff so they will know how to use the equipment. So that's a pretty good list of what will come into the value of the asset and what should be expensed immediately. So transaction costs, including legal fee, borrowing costs if they are incurred, delivery charges, import duties, irrecoverable purchase of taxes, and net present value of unavoidable future decommissioning costs under IAS 37. This is valid for mining industries, for instance, for oil. So basically, once you actually have installed an oil rig, okay, you will be exploiting it for 20 years. But the license to actually operate into that location will tell you to actually remove the oil rig and then restore the site. That is called decommissioning cost, and it will be included in the value of the oil rig, which basically will be included at the present value over 20 years, and you will get depreciated. Each and every year, remember, we will increase it back with the finance charge in order to reach our estimated liability at the end of 20 years. And installation and assembly costs, site preparation costs. What we will never be including in the value of an asset is going to be the training cost to be able to actually use the asset, any inefficiencies or losses that we actually have at the first run in of the equipment, any admin and general overhead costs, any costs which are actually given benefit for 1 year or less, any cost due to abnormal losses in the purchase, delivery, production that will not actually enhance the earning capability of the asset. So basically, if I have an engineer and I will basically start installing an equipment on a wrong site, then the cost of actually removing and reinstalling the equipment in the proper site, it will never be consolidated or included in the value of the asset. That's the initial recognition. Once we basically recognize an asset, it cannot stay in the statement of financial position at the same value. We have to depreciate the asset exactly in the pattern that we were basically going to use the asset. So what we want to do is to actually match the income stream that the asset is generated with the way the asset is consumed. Depreciation, it will never be aimed at showing the market value of the asset. Okay, the only concept to have in mind is matching costs with associated benefits as closely as possible. So any change in the depreciation method, which can be, I don't know, sum of digits, straight line, diminishing balance method, okay? Any change in depreciation is going to be treated as a change in an accounting estimate. It's not a change in an accounting policy in accordance with IAS 8. And remember, the difference between the two is if I'm changing an accounting estimate, that will be applied prospectively, but if I'm changing an accounting policy, I will have to go back and restate. Impairments. So IAS 36, which I will cover in a second, it will tell you one thing and one thing only. You cannot show an asset in the statement of financial position at the year end at an amount which is higher than the recoverable amount. And we learn how to compute the recoverable amount. So if we have, let's say, an item of property, plant and equipment at a value higher than the recoverable amount, we will have to recognize a loss. How we'll recognize the loss is normally in profit and loss when we actually foresee it. If we are not using the historic cost accounting and basically we are using the revaluation method, meaning at the end of each accounting period I'm actually presenting the asset at the market value, then any impairment loss that arises will firstly be charged to the revaluation reserve, and then if we write it down to zero and still we have some impairment loss, we will book it in P&L. So in terms of accounting policy, we do have a choice in IAS 16. One will be to present it at historic cost, meaning I will present the assets in the statement of financial position at historic cost, less accumulated depreciation and less accumulated impairment losses up to date. The second accounting policy choice that I will have in here is to keep it at the market value, okay? So that will imply revaluation, which the standard says that it should be done with sufficient regularity just to make sure that the value of the assets are as close as possible to their market value at the reporting date. If we choose to revalue an asset, the following should be kept in mind. You have to revalue the whole class. So I can revalue land and buildings. That does not necessarily mean that I should revalue, I don't know, fixture and fittings also. But I cannot revalue only one building, the one which is sitting downtown, and forget about the other buildings which I have. We must keep it up to date. Okay, the standard says sufficient regularity, not necessarily on an annual basis. You must disclose the valuation, details of valuation, and whether or not it was done by the directors. The problem with choosing this accounting treatment is you don't have the alternative to go back to historical cost later. Depreciation charge in P&L will be based on the revalued figure, meaning we will have a higher depreciation charge. And sometimes it's common to make an annual transfer from the revaluation reserve to retained earnings of the difference between depreciation on revalued amount and depreciation that is basically charged on historical cost. And we talk about this transfer when we actually presented a statement of changes in equity. And any gain on disposal is likely to be lower, since it will be computed as the difference between the selling price and the revalued amount. Any subsequent investment, any enhancements basically that we do to non-current assets, it will be capitalized, or in other words included in the value of the assets if and only if they enhance the earnings generated potential of the asset. So in other words, if they increase the economic benefits which we are obtaining by using the asset. So if I'm upgrading a server memory capacity, that will be an expense that will be capitalized and depreciated over the remaining useful life of the server. If, for instance, I'm just repairing the server or the hardware, that is just a repair cost which will be expensed immediately in the P&L. The disclosures regarding to property, plant and equipment are extensive, and in most of the cases the companies will use a tabular form. We will have to basically reconcile the opening and closing balance for cost and accumulated depreciation, presenting the additions during the accounting period, disposal, acquisition under finance leases, the carrying value of the asset, which is the difference between the cost less accumulated depreciation and impairments to date, the basis for valuation for each class of asset, which could be either cost or valuation if we are choosing the revalued amount, and for any major class of assets, if we are actually having restraining on titles, so for instance we pledge them as security for loans that we took them for the bank, that will also be disclosed. One other thing that will be disclosed is if we have assets that are depreciated, but they are not currently in use. That should also be disclosed in the notes. Borrowing cost. This is covered by IAS 23, and actually this standard says the following: all the directly attributable finance cost to the acquisition or the production of an asset must be capitalized. The capitalization will actually start when the construction begins and will stop when the equipment is ready for use. It does not necessarily will be exactly the same date when it is actually brought into effective use. But when it's ready for use, then the capitalization of the borrowing cost will stop. What capitalization means? It means if I have a loan which is actually taken to build up a supermarket, let's say, I can take the interest which is paid on this loan and include it in the value of the asset over the period of construction. If I don't have a loan which is taken dedicated, for instance, to build a supermarket, I can take weighted average of the company's finance cost and still include it in the cost of the supermarket. Once the supermarket is ready for use, the interest will be charged as normally in P&L as an expense of the period. Profit and loss on disposal of any non-current asset. Remember one thing, every time a company is selling something, a non-current asset, an inventory, they are bound to make a gain or a loss. The gain or a loss will always be computed between what is the net proceeds which I'm actually receiving less the carrying value of the assets which I'm derecognizing. So, in other words, the easiest way to remember it in the exam is what comes in the statement of financial position, which is the cash that I'm receiving from the sale, what goes out from the statement of financial position, and that is the carrying value of the asset. The difference between the two will be a profit or a loss, which will be reported in the P&L for the period. Remember, if the asset was revalued at the time of disposal, any revaluation surplus which is still sitting in the revaluation reserve will be moved to retained earnings. So from revaluation reserve, you'll move it to retained earnings. Revaluation reserve must be kept on an asset by asset basis. That's why when I no longer have the asset in the statement of financial position, I will have to move the associated revaluation reserves to retained earnings. Let's talk about IAS 38 intangible assets. These are basically assets without physical substance, but they should be identifiable from the rest of the business. The main type of assets which are covered by IAS 38 is research and development expenditure, is goodwill, and we'll cover this in depth when we'll talk about group accounts, and other intangible non-current assets like trademarks, any patents, software, you name it. What we'll cover again in this standard is pretty similar like IAS 16. When should we initially recognize the asset? At which value? How do we amortize it? Do we revalue it? And any impairment loss and allowed alternative for presentation. This is actually covered in tabular form for us. If you are basically looking at page 34. Let's cover research and development. So research and development expenditure, the accounting treatment is fairly different. If we are talking about research, this cost will always be expensed, and the reason for this accounting treatment, so they will be written off directly in the P&L. The reason for it is that we are not sure whether or not we will have future economic benefits. So yes, we do control the project. We are aiming, I don't know, to find a new material or a new production to actually production process to decrease the costs, but we don't know at the research phase whether or not we will succeed. And since it does not meet the definition in the framework, control and future economic benefits, we will write it off immediately. When we actually move into a research phase, then this cost can be capitalized if basically we are certain that we will enjoy future economic benefits. How we can be certain? The standard actually says the following: we will have the ability to complete the project. The project, it is technically feasible. We have enough resources to complete the project. We will enjoy future economic benefits. We have the intention to complete it, and the expenditure on the project can be separately recorded. And that can be easily remembered by the mnemonic red pie. So R stands for resources to complete the project, ability to complete the project, technically feasible, probable future economic benefit, intention to finish, and measure the expenditure reliably. The initial valuation of development cost, it will be all costs incurred, including transaction cost. The amortization period, okay, must be revised annually in order to actually match the cost with the associated benefits. Any upward revaluation, the standard says this one is not really possible to be chosen as an accounting alternative to historic cost unless it's basically reversing a previously recognized impairment loss. Why can we actually choose the revaluation as a possible accounting treatment for intangible asset? Is the following. The standard IAS 38 says we have to have a reference to an active market when we talk about the revaluation of intangible asset. And per the definition of IAS 38 of an intangible market, it actually means that the items traded should be homogeneous. That's the first criteria. The second one, we have to have willing buyers and sellers. And the third one will be that the prices should be available to the public. And the problems appear basically when we talk about the first criterion. The items traded in the market should be homogeneous, and you can say everything about the pattern is pretty much anything else but homogeneous. So they are unique, totally different. That's why I was able actually to obtain a patent. So that's why I cannot make a reference to an active market. And actually the standard says that the circumstances should actually be rare. Impairment loss, okay? We will recognize impairment loss exactly as per IAS 36 rules, meaning it will be booked in P&L unless we have a revaluation reserve, which we pretty much discuss it's not the case. Any reversal of the impairment losses, yes, they are possible, if and only if the impairment indicator who actually lead us to book the previous impairment are not likely to happen again. So not likely to happen again. Let's talk about goodwill. Internally generated goodwill will never be recognized. Why? Because we don't have control and we cannot measure it reliably. Purchase goodwill, on the other side, will be recognized as an asset if it's positive, and negative goodwill on the acquisition of a subsidiary will be immediately written off as a credit to P&L. Goodwill will always be defined as a difference between the fair value of consideration paid to acquire a subsidiary and the fair value of the net assets of the subsidiary which were acquired. Transaction costs will no longer be included in the value of the asset. They will be written off to P&L immediately. Goodwill will never be amortized. It will be tested annually for impairments because goodwill is thought to be an intangible asset with an indefinite useful life. It will never be revalued upwards because the revaluation upwards is just showing internally generated goodwill, and we agree that this will never be shown in the statement of financial position. Reversal of impairment losses will never be recognized pretty much for the same reasons. If I impair the goodwill on the acquisition of a subsidiary, it will go up in value if and only if it's actually replaced by new and internally generated goodwill. And we are not allowed to show this in the statement of financial position. The method used to show is either gross or proportionate method, and we'll talk about this when we talk about group accounts. And the other intangible non-current assets, which is pretty much everything else, licenses, patents, trademarks, we will be recognizing them if we have control and if it will generate us future economic benefits. Initial valuation is all costs incurred, including transaction cost. And the amortization period will be over the period in which we are expecting benefits from the patent. It does not necessarily mean that it should be straight line. Revaluation upwards might be possible, but again, reference to an active market, and the problem with the active market is that we don't have products which are homogeneous. Impairment loss is going to be recognized in P&L. And a reversal will be possible if we can demonstrate that the impairment indicators are not likely to happen again, and we don't have any other alternative method of actually valuing the intangible assets. And everything that we talk about in the tabular form, it's explained to you on page 35. And 36 for write-off periods, impairments, revaluation, active market, and why basically we do not have an active market for the intangibles. The enhancement costs will actually follow the same treatment as per IAS 16. If we have higher or we increase the earnings generated potential of the asset, yes, we will capitalize it and write it off over the useful life of the intangible, like an upgrade for a software that is now going to generate more revenues. Other costs like repair of hardware, as I said, it will be expensed immediately. IAS 40, investment property. Under the scope of this standard, it enters what we call a property which is owned by us, okay? And we are actually holding that property to obtain a rental income or to gain from the appreciation in value of the property. It can include part of the building or an entire building on its own. If you have an investment or a property that you did not decide what to do with it yet, so let's say you have a customer that went into liquidation, he cannot pay the debt to you, and you actually get, I don't know, his main office. If this happens at the year end and you did not yet decide what to do with that main office, you will account for it as under IAS 40 investment property. Under investment property, we will never include owner-occupied building, that is IAS 16, or facilities which are basically used in production and supply of service and admin. That is IAS 16. Investment property may be held under finance leases, and if so, it will be capitalized at the lower of either net present value of minimum lease payments or the fair value at the recognition date. And we will use the asset recognition criteria prescribed in IAS 17 leases. Subsequent valuation of investment property, again, it's the same accounting policy choice. Either you can use the cost model or you can use the fair value model. If I'm using the cost model, I will follow the rules of IAS 16. If I'm using the fair value method, I am not going to depreciate the asset at each reporting period, and I will revalue it to the market value, and I will report the gain and loss in P&L. This accounting treatment is mandatory for operating lease investments. So no depreciation, gains and losses in P&L. Government grants. This one is covered by IAS 20, and in here we can have basically two types of grants. So the government may grant us some money either in relation to the income meaning I will get some subsidies from the government, I don't know, to go in a remote area and start developing. And in here, if this is the case, what I will show in the financial statements is the gross expense and the grant as a separate item of income. So I will have income, money coming in from the government, and the expenses for running the operations in that remote area. Or I can show the net expense in the profit after deducting the effect of the grant. I'm actually all in favor of the first choice. Or I may receive a grant for the government in relation to an asset. So in this case, the accounting treatment, it will not be proper to use the same thing as we have done for a grant which relates to income. If I'm buying an asset, then the asset will be depreciated, I don't know, let's say over 10, 15 years. And it is actually normal to show the grant, okay, alongside the depreciation to actually match it with the cost. So basically I will have the asset at cost and the grant received as a deferred income, and on a yearly basis, based on the depreciation charge, I will actually release part of the grant received from the government. Or I can show the asset net, meaning net of the grant which I'm basically receiving. Grants will always pass through P&L sooner or later. If it relates to income, it will be sooner. If it relates to an asset, it will be actually charged to P&L over the depreciating period. The grants will actually be recognized if you are reasonably certain that you will be obtaining the grant from the government, okay? Changes to the recognition of the grants. If you are in breach of regulation or you no longer fulfill the criteria for the grant, and the grant actually will become repayable. So for instance, I'm changing the plans of the business and I no longer qualify for the grant. The repayment of the grant will be shown in the year when it becomes apparent that I will have to give the money back to the government. The recognition of the liability to repay the grant, it will be immediately in P&L. On the other hand, if I become entitled to receive a grant after completing a period of, I don't know, qualifying expenditure, the recognition will be again in P&L once I qualify for the receipt. In other words, changes to estimates of the right to receive a grant will normally be presented as a change in an accounting estimate. It's not a change in an accounting policy. IAS 36 deals with impairment of assets. Again, I cannot show an asset at the end of the reporting period at an amount which is higher than the future economic benefits which I'm expecting the asset to generate. That is again in line with the definition of an asset in the framework. So how can I basically recover the value of an asset? There are two sides of it. Either I keep using the asset in my business, so therefore this is called value in use, and I will be looking at the net present value of the net cash flows which are generated from the asset, or I can sell the asset, in which case the recoverable amount of the asset will be the fair value less cost to sell. Recoverable amount is the higher of these two values. Either fair value less cost to sell and value in use. The recoverable amount will be compared at the year end with the carrying value of an asset, and the carrying value of an asset, if it's higher than the recoverable amount, then an impairment loss will be booked, normally in P&L. We will not run this exercise unless we do have for most of the assets an impairment indicator. And an impairment indicator can be external or it can be internal. An external indicator is, let's say, a fall in market value for that particular items. It can be significant changes which are not that favorable to the business. run by, I don't know, derived from political factors, economical, sociological, technological, legal, or even environmental. So basically, if you have a subsidiary in a foreign country and the legislation basically in that foreign country changes, which will allow, let's say, to repatriate the profit, will disallow to repatriate the profit from that country, then you will not have future economic benefit from the subsidiary that you have in that respective country. It may be the fact that the interest rates are raising. So remember, if we are taking the net present value computation, the higher the interest rate, the lower the net present value. Remember the formula, 1 over 1 plus the rate to the power of n. If the rate goes up, then the net present value will go down. Or we have internally generated negative goodwill, which means that the market capitalization is actually lower than the book value of the asset. An internal indicator will be the physical damage of the asset, the obsolescence, okay, the change in the business plan of the company, or poor performance from usage of the asset. So once we do have an impairment indicator, we will actually compute the recoverable amount. And we will look at both options, the selling price less cost to sell, which is the amount that we basically can obtain for an asset or for a cash generating unit in an arm's length transaction between an eligible willing party less the cost of disposal, meaning it should not be a transaction between related parties. The value in use is the present value of future cash flow, which are expected to be derived from using the asset or the cash generating units. The concept of a cash generating unit is the following. Not all the assets in the company will generate independent cash flows from the other assets in the company. So therefore, it will be practically impossible to value individual assets. So instead, we have to actually look at the cash generating unit. The cash generating unit will be the smallest identifiable group of assets which can generate cash inflows, which are largely independent than the cash inflows from other assets or group of assets. So in short, it will be the smallest group of assets which together is seen as a going concern. Reporting impairment losses for individual assets. Normally, an impairment loss, it will be charged directly in the P&L. The only difference will be if you have used the revaluation model or accounting treatment for that particular asset. Because if I'm having some revaluation reserve, the impairment loss, it will be charged first to revaluation reserve, and secondly, I'm actually showing it in the P&L. If there is a reversal of the, if it's a reversal of the impairment, I will reverse it exactly in the same way as I book it. First to P&L and then to revaluation reserve. For a cash generating unit, so I will determine the recoverable amount of that cash generating unit, which can be either the value in use or the fair value less cost to sell, and I will compare that value with the carrying value of the total assets which are included in that cash generating unit. I will determine the impairment loss, and then I have to allocate it, and the rules for allocation is: first, you actually allocate it to physically damaged assets. Second, you write off any goodwill which is attributable to the cash generating units, and if something else is left, you go on a pro rata basis to all the remaining assets in the cash generating unit, but never impair an asset below its individual recoverable amount. So for instance, if I will have, let's say, a taxi company that I will need to impair it, and the whole company on its own is a cash generating unit, and if I have the license to operate in the city and I have a buyer for that license, I cannot impair the license below what the competitor is actually willing to pay me. Any reversal in a cash generating unit, okay, it will be done first of all if the impairment no longer exists, and normally it will be reported as a credit to P&L, but there's one rule to remember: goodwill can never be reversed. Why? We covered this, if you remember, IAS 38 also. It will actually mean that we will be recognizing in